Recording in progress. You ready, Kent? Oh, you're on mute.
See, I try not to have, try not to have stuff going on in the background. Yeah, I'm ready.
That's smart. That's smart. Well, if for those uninitiated, Kent Williams is with Fidelity Direct Mortgage, and Kent, I can't speak enough about you. I'm going to let you do a lot of the talking as far as your company, but one of the things that I appreciate the most is that you give it to us straight. There's no lost words when I talk with you. It just, I need something, we figure it out and we move forward. And there's no reason to kind of be anything different than that. We're not trying to sell a loan. We're trying to perform a loan or give the best advice we can. And I think you're a great partner for me in that sense. So I appreciate all that you're doing. And then I
appreciate that.
I also appreciate you coming on these classes because I think having a lender involved in addition to two attorneys is probably a really good dynamic because we can see it from many different angles.
Doing this as long as I have, what I've found is the worst thing in the mortgage industry, head loan officer, where that's always, we can, no, you have to get the information and make a correct decision.
Yeah, well, and then so let me ask you, Kent, what I wanted to talk in this class was about the new NABOR contracts, and I know you're not familiar with them, so I'm not going to put you on the spot, but as far as contracts are concerned, what does a lender need to know about a contract? Where do your eyes go to when you're evaluating contracts? You see one that's coming in that your client just signed.
Contingencies number one, like when's everything due? And then it's funny, the best advice that I ever got when I started in this is read the contract. People don't read the dang contract. It blows me away. Because there could be a seller concession or something that's going on down in the notes that you didn't catch. And if you didn't, you just, you're starting off on the wrong foot. So read the contract. But contingencies, appraisals, that kind of stuff, but read the contract.
So let me ask you another question. This is a little off topic, but because you're here, I'm going to lean into a bit. I had a deal come in this morning. I think the sales price is $760,000. And there's a $40,000 credit to the buyer, seller to buyer. And so I talked to the buyer and he says, my lender says I can do it. I said, that's great. Awesome. Must be a lot of fees. And he says, what do you mean? I can get a credit up to 6% on the type of loan I'm getting. I said, yeah, as long as you have that amount of costs. So here's what he was doing, Ken. And so the first part of it,
you could do 6% if it's an FHA loan. If it's a $700 and some odd $1,000 purchase price, it's wrong.
It is, yes. But again, you have to have those actual costs, right? You'd have to have $40,000 in closing costs to use a $40,000 closing cost credit. That's true. That's how I always say it.
We could potentially use some of it buying down rate, but yes.
Yeah, so buy down rate is a closing cost, a survey. Is insurance a closing cost?
No,
it's not. Okay.
But hang on, but it could be towards closing costs and prepaid. So it just depends. Again, read the contract. What did they write in there?
So here's what he's doing. This is what I found out. The property was listed for $720. He offered $760 with a $40,000 credit. The seller's saying, fine, awesome.
Right.
The buyer's perspective is if it appraises above $720, I'm in the money. That's more cash flow. Yes, it's more loan, but he's an investor. He's thinking that way. Have you seen that before? Are there any things that we need to worry about other than
I will advise people on that sometimes, but only if I've seen a very recent price reduction. So if something's been on the market and things have been selling and it's great, and then they go, okay, well, we're going to reduce our price 6%. Well, that's the time where you can come in and go as a realtor, hey, listen, don't reduce your price, keep it the same, give us a concession. Yeah. It's going to be completely different versus something's been on the market for 90, 120 days at $720 and you go in, hey, we'll give you this. It's not going to appraise.
Yeah, that makes sense. That makes a lot of sense. Have you seen that a lot, Dad, before?
I have, and usually I tell people, talk to your lender. They usually have special verbiage they want in the contract. The seller's crediting the buyer $40,000 for closing costs, prepays, and escrows. So you want the appropriate language. And the other big bugaboo is, watch out for furniture. they don't want to see that on the contract.
Yeah, so typically our advice on furniture is that it needs to be separate and it needs to have a value attached to it. So Dad, if I know we're getting a little off topic, but this is what this class is all about.
Right.
On furniture, I had a question yesterday. Someone wanted to put a $50,000 number on the furniture and the rest would go towards the purchase price of the unit. And I said, my first question, what is the furniture actually worth?
Good one.
So can you kind of walk everybody through how
I've had a number of those. I had one client who had, I think it was $300,000 worth of furniture on the contract. He was in a business that was regulated by the Securities and Exchange Commission. We had to have appraisals to show that it was actually worth $300,000. But when push came to shove, the client decided, the SEC looks at me every year. I don't want to deal with it. So he took it off the contract. I start the whole thing by, why are you doing this? And usually you get buyers who think they're going to save a lot of money in the ad valorem taxes. They're from Westchester County, New York.
Taxes.
They're worried about that. And I had a New York judge who wanted to exclude, it's either $300,000 or $400,000. And what I did was I called the appraiser's office, and they have a condo department. And I got a young lady, I think her name was Wendy or Holly, something like that. It was probably 10 years ago. And I asked
the Wendy's and Hollies out there.
It was the Biltmore in Pelican Bay. And I asked her, Wendy, I have a New York judge, you have to be careful. He's used to being treated a certain way. How does this work? He wants to exclude $300,000. And she told me, we look at the comparable sales above the unit, we look at the comparable sales below the unit, and we go by that more than any furnishings. So what I did was I called the judge back and gave him Holly's phone number and said, this is what she told me, but please call her yourself. And I ended it with, if you leave the furniture in, your adjusted basis in the property is that much higher, so that when you turn around and sell it, assuming it's not your home, you don't have to pay tax on it.
Yeah, a lower capital gains hit.
Yeah, but it's all driven by, usually 9 times out of 10, they're trying to save money in the ad valorem. And 9 times out of 10, that's just one tiny factor in the equation. Yeah. They need to talk to somebody at the appraiser's office.
Yeah. So the advice I gave yesterday on the 50,000 thing was, what is it worth? And they said, well, if they were to go buy all this stuff, it might be fit. I said, no. If you were to sell it on Craigslist, what is it worth? And they're like, well, maybe
$1.95.
Yeah, maybe $1.50, something like that. And I said, okay, well, here's the thing. You're taking a lot of risk that you're going to get audited by the state of Florida Department of Revenue or by the IRS, or you're taking a lot of risk to save $100 in title insurance and $200 in transfer tax. If the client wants to do it anyways, I'll tell you how to write it, but we don't like it. We want it to be accurate. And then from the lender perspective, Kent, what you can't show it as part of the purchase. Yes, you want it to be separate. If they're buying furniture for 10 grand, they're buying furniture 10 grand. That's separate.
Back in the day, it was a thing. It was a thing that you could say being left as a convenience and blah blah blah, and it was fine. But those rules changed a good while back, and no, I don't want to know anything about any furniture.
Yeah. Well, the other side of that is if you say the furniture is worth 0, but it's not. Kent looks at that and he's going to say, well, I'm not giving you a 30-year mortgage on a $100,000 Bentley. Right. Yeah.
Correct.
Yeah.
The other thing is, if it's the big numbers, if it's a $300,000 credit, which is not uncommon, is this going to affect the realtor's commission? Because 6% of 300,000 is a lot of money. Yeah. So I make sure that the agent is still getting paid on the total amount being sold, the furniture and the real estate.
Yeah.
Right. Does the couch have a fixed foundation?
Yeah, that's a good point. So Bob says, what does the mortgage lender look for with condo docs as far as financials? Operating reserves, building reserve, plus accounts receivable. Kent, can you answer that one maybe?
Yeah, it's basically approved budget and reserves. Yes, it's going to depend on the condo, but the big thing nowadays has been the condo questionnaire with the structural integrity addendum. That's been the big one, and people have been trying to get around that, saying, well, we're putting 25% down, so we only have to do a limited review. Doesn't matter. You're still going to have the structural addendum answered, because ever since the Miami towers fell, that's a big deal.
Wow, Kent, you just nailed the transition there. Look at this new form that NABOR has. Condominium and cooperative safety disclosure. All right, so on July 1, the Florida legislature enacted legislation for consumer protection and safety, requiring periodic inspections of the structural integrity of the condominium cooperative buildings, which are 3 stories tall or higher. So obviously, if it's less than that, if it's a 2-story duplex, it's not going to apply. Specifically, a structural milestone inspection is required by a licensed engineer or architect when the building is 30 years old, or 25 years old for buildings within 3 miles of the coast, which is a lot of buildings around here, with updated structural inspections to be conducted every 10 years thereafter. So Kent, you mentioned this briefly. What are you looking at in this regard? Are in compliance with the state statute? Is that what you're thinking?
Yeah, well, it depends on, number one, the type of loan it is. If it's not a Fannie or Freddie or a TRID type of a property, it might not be an issue, but most loans are. So yeah, we're going to be looking at obviously they're going to have to fill this out or sign this, but there's going to be literally a questionnaire that talks about have you had a structural inspection done? Who is it done by? When was it done? What are the results? You're going to have those questions. They have to answer those, or loans are not going to be funded.
All right, so that's awesome, Kent, thank you. Where I see this going, and Dad, I'll pull you in on this one. We wrote a couple articles the last few weekends on the difference between HOA disclosures and condominium disclosures. Dad, is a quick primer. Condominium disclosure, Florida statute, go. Where would the buyer, so this disclosure is being used to basically educate the buyer that this is a thing. What should the buyer do with this? Where do we take it from there?
Within the 3-day review period of receiving all 7 documents referred to, I think NABOR has it in standard I. Within that 3-day period, you and I talk about this, the buyers need to get their hands dirty. They need to call the management company. There's a lot of ancillary information they're going to need, pending insurance claims, budget issues, lawsuits potentially. But during that 3-day period, during that telephone call with the management company, ask specifically for the engineer's report on the structural integrity of the structure.
Yeah, so exactly. That 3-day inspection period needs to be used for the purposes of getting these questions answered. So the seller has gone through the difficulty of disclosing about this statute and these new requirements, and giving all of the documents, the bylaws, the covenants, the governance form, financials, and the buyers from New Jersey, the buyers from Michigan. Right. And they don't really understand these rules. They need to get their hands dirty, like you said, Dad. They need to go down to the property manager, ask their questions, show them this and say, what is this? And then say, look, I'm working with Kent, and I need to know, is this going to be a problem for him? What do I need to give him? And can you answer these questions? Because the issue I see brewing with this sort of stuff is that the buyer doesn't ask this question during the 3 days, and then 2 weeks later, they're getting denied for their loan, and they may or may not have a financing contingency to protect them in that event. So
well, when I'm doing that pre-approval, and I know we're looking at a condo, I'm going to be bringing that up before you put your offer in.
Well, and that's why you're different, Kent. And that's I don't want to brown nose you too much, because
too much.
You're not paying me that much.
By the way, anecdotally, I'm doing a deal right now this month in a condo in Miami. And when I asked for these things, they already had the structural engineering done. They had everything done. Boom, back to me. They're ahead of the game because they had to start on this, a year ago. Whereas here, NABOR is just making the contract change now, right? So it's flowing over, but they're ahead of the game over there. It's going to be happening everywhere.
I suspect they're ahead of the game, not just because of geography, but because a lot of these condos in Miami might be paying with a mortgage. In Naples, there are less mortgages, and so the boards to almost shun doing these types of updates because most of their homeowners don't even have a mortgage that they have to comply with. But yeah,
Right.
it's something that everyone needs to be aware that if your buyer has any mindset of getting a loan, that this is something that is, you wouldn't think it's part of the loan, but Kent's going to have questions that need to be answered by the board. And it's a big one. So NABOR has this on here. Just keep in the back of your mind, this goes with every condo sale you do, every single one. This one's got to be on there. So these are the contract changes. And this is kind of a trainer packet, because what's nice about it is it highlights what has changed, and it makes it very simple to see where the differences might be. Now, generally, you're not going to be that upset. There are not that many changes. Most of these things are little incidentals. I'll give you an example. They changed, instead of calling it Condominium Association / Homeowners Association, I believe now they just call it associations. And so those are the types of things they did. They tried to clean it up. They tried to remove any sort of inconsistencies or vagueness. But they did add some different things. We've seen the smart home components become more and more on these homes, specifically electrical vehicle charging equipment. This is something that's part of the real property now. It's going to go with everything else, including access codes. So that's that's just kind of as times change. As the last time they updated these contracts was about 2 years ago, and this is an improvement on that because of what has changed. Darlene has a question. It goes with every single condo contract ? Even if less than 3-story and or not being mortgaged. Darlene, it's a great question. If it's less than 3 stories, I could see you not doing it because it doesn't apply for that type of building. I would understand that part. That being, what was that, Deb?
It's not legally required, but
not legally required, but doing an over disclosure is not a bad thing. But I would say, even if not getting a mortgage, that disclosure needs to be in there. It is state statute. It doesn't really have anything to do with the mortgage or not. It's just that Kent has certain questions he needs answered regarding that statute to get the mortgage. And what we see a lot is, Darlene, where the buyer intends on paying cash until like the week of closing. And they've talked with their financial advisor who convinces them, hey, you need to get a mortgage, call Kent. Right, Kent, that's like half the phone calls.
Yeah.
Oh my God.
So yes, Darlene, any building that is in that 3 stories or higher, include this disclosure. Anything that's below the 3 stories, you have the option. You're the salesman. We'll let you decide.
I'd be safe and just attach it.
It makes sense. If it's a condo, attach it. Condo attach.
I do love when I get the phone calls and the first question is, how quick can we close?
Yesterday.
Well, Kent, it makes you feel any better. I get the same questions. I just throw you under the bus. It's great. Blame the lender. All right. So the next thing that changed, it looks like they just changed the where they put the financing contingency and kind of how it looks. They put the conventional VA, FHA, or other up front on this, as opposed to it being a little bit further down, but it works the exact same way. Nothing to worry about there. This is where you'll see the change to the condominium / homeowners. That's what it used to say. And so now they're just changing it to association, just trying to clean it up. That's all that is. And I think that's probably a good thing. This part I think is very interesting, because I had a problem with this a week ago. So this is the standard NABOR contract. They removed the right to make it an as-is contract with the addendum. So you used to be able to use the standard contract and you could say A, right to do inspections, or B, a due diligence, as-is addendum to be attached, or C, just waives the right to all inspections. So they took out B. If you're doing an as-is contract, use the as-is contract. And I think that was the point of that.
Well, we'd get a lot of questions on whether there's a difference between adding the addendum or using the as-is contract. So it eliminates questions for you and I, Chris.
Yeah, it does. Absolutely. So Marcia has a question. Let's see if I can answer it. with both of you guys here. Some condo associations do not return phone calls and requests in a timely fashion. Yeah, that's an understatement, right? When they
I'm
push
shocked. I'm
back and
shocked.
neglect, what do we do? So this is the problem. First, I would get all your condo docs before you actually list the property. This is something you know you're going to need. Don't wait until you have a contract, especially if we're going into busy season. You don't want to get caught behind on some of this stuff. But the listing agent hopefully will have it by the time you're already there. But if you're the listing agent and you are caught at that point where the association simply won't return your phone calls, then that 3-day rescission period continues. The seller has an obligation to give these things to a buyer. And so you're basically giving the buyer a free look. They could terminate for any reason until 3 days after receiving the actual documents. Is there anything more to that, Dad? Is there any other suggestions you would give?
I get the FSBOs, and what was one last week where they were just going to drive down to the management company, meet with the people, which is good because you get a better feel for the place, what it's like socially.
Go in person.
Whether they'd be happy being there.
Yeah, Marcia has a follow-up. Maybe she's clarifying. The engineering reports may not be available. And this is actually, Kent, this is a question for you on this part. What specifically, and you've shared this with me before, there's a new form that Fannie Mae, Freddie Mac has that they have to answer, right? It's not that the reports have to be available, but they have to be able to answer certain questions. Am I right?
Correct. Yeah, it's an addendum. Fannie and Freddie addendum, condo.
So full disclosure, when Kent is ordering a mortgage, he sends the title company, sends my dad and I a title order, and then the lender sends an estoppel request to the condo specifically and says, Condominium board, we have certain questions before we can fund. Here's what I need you to answer. And when this statute was passed, they basically added a new addenda to that form packet and said, we need you to answer these questions as well. It is a very normal thing. Condos are, they're supposed to respond to these, but obviously if the condo board is not responsive and just blows off the lender can't close. It's that simple. And it doesn't mean that there have to be reports, especially I think, when did I say this statute was passed? Was this summer, I think?
This summer.
So it hasn't been very long. So in time, those reports will be more and more available. But in the meantime, Kent just needs questions answered.
Is it possible to get these forms before, when you get the listing initially? Just have them ready with the other condo docs? That's a question for Kent.
It's a good question for you, yes. Kent. Have you ever seen where it's provided by someone?
I always tell realtors too, when you take a listing, first thing you should do is go meet the condo association and ask them for these things. Because if you have that answered and you could even put it in your listing, condo docs available or condo questionnaire available, whatever the case may be, they're usually going to charge you though. I mean, you're not going to get a free lunch to get that filled out. But it's not a bad idea to get that done up front. That's going to put you at the top of the list for a sale.
But this engineering report would be acceptable to the lender, Kent, if it's beforehand?
Yeah, I think there's got to be there's a certain time frame, and then as long as the certain things were answered as far as the structural integrity, it should be fine. But
maybe what people should do is reach out to their lender ahead of time and ask Kent, hey, what is going to be asked for? Let me see if I can jump the gun on it. Marcia, she had another follow-up. What if the buyer, you're the buyer and the listing agent is remiss, which is a great word. Marcia, I would say make sure that you have a financing contingency. That's the key. Because if you don't have a financing contingency, or if you waive it and the board doesn't get this to you, the listing agent won't be making your buyer whole. They'll be taking your deposit. So yeah, it's very tricky. And one of the biggest things that the three of us have to do in our jobs is we have to be able to determine whether we can trust something or not. Dad, you always said, he was like, I know when someone's lying to me because I've been lied to for 30 years in this job.
I got lied to for a living, as I would tell you.
Lied to for a living. And so I don't mean to be so negative, but it's really that blunt. You have to protect your client. So my motto is get it under contract, protect your client, get it closed. And you have to do all three. Have to do all three. Kimberlina, yes, I will send out these forms, no problem. They'll be live on NABOR tomorrow as well. Let's see. And then I think Bob had another question too. I love how people are asking questions. So Bob says, oh, Bob, you answered, Kent. Do you want to take that?
Yeah, it was just regarding insurance. With condos, the insurance is covered with the Condo Association Master Policy. You are required to get what's called a studs in policy. It's very inexpensive. I mean, the one that I'm doing right now, it's a $460,000 condo in Miami. His studs in policy is like, it's less than $1,000 a year. So it's not a lot. So it shouldn't be an issue.
But I think the main point there is get your lender in advance, get your insurance broker in advance.
Yep.
You got a quote on your insurance right away.
Yeah, and I think
Absolutely.
you can bind it as soon as you're able to bind it. We had people that closed the week of Hurricane Ian because they had bound their insurance 2 weeks earlier. So once they're bound, the insurance company can't, retract that, and the moratorium doesn't apply anymore. So we had a couple of closings the week of the hurricane, even though a lot of other closings had to get delayed because of the moratorium, which I think is very interesting.
We swam to work.
This is one thing that my dad and I will see change, in our practice. It used to be that if the property is located in Collier County and seller fails to furnish a copy of the owner's title policy within this time frame, it's 10 days, seller shall give buyer $150 credit at closing in lieu thereof. I think it was probably meant to motivate the seller to provide this, which helps us quickly get an updated title policy. But they took this out. There's no more $150 credit. It still obligates the seller to deliver, but there's really no consequences.
There's no sanction. But we would use that to possibly give the buyer a reissue credit, save the buyer a few dollars. And we would also use it to see whether or not our underwriter picked up the same exceptions to title that the prior one did. It's a good fail check to make sure our underwriter didn't make a human error.
Love it. Love it. This is something that doesn't come up very often, but when it does, it's a big challenge. And that's surveys and survey objections. They tweaked the language. They added a new thing that the survey has to comply with applicable development standards of the local government having jurisdiction. So that'd be like zoning laws and variances and setbacks and things of that nature.
As long as it's not legally non-conforming. I think there's a big misconception about surveys. Sellers understandably resist looking for the surveys until there's a problem raised when the buyer orders a new survey. So I always urge the sellers, dig out the old survey. It might be quite old. They were done perhaps with different technology, and hopefully they're clean. They comply with all the setback requirements and no encroachments. That will save the seller from running into a situation where the buyer gets their own survey that might have a 1-inch encroachment into the building setback requirements that requires the seller to pay a $1,000 administrative variance fee with the county.
Plus attorney's fees.
It really saves the seller money more times than you would think. We see that quite a bit, and it generates a lot of goodwill with the buyer. You're saving the buyer the cost of applying for their own survey. And a lot of times you can recertify the survey to the buyer, so they get a double layer of protection.
Yeah, we typically want a survey that's less than 10 years old and that's certified to the seller, not to a prior seller, and that has had no changes. And if you have something like that, send it over to us. We'll look at it. We'll walk you through with it, and then hopefully we can get an update, something that's certified to the buyer. Dad, can you explain what certifying to the buyer would mean? What kind of protection that might give?
Well, the survey company has made an explicit promise or warranty to that particular person or persons that this is accurate. So there's liability if they made a mistake versus one where there's the affidavit of no change that the contract refers to, where it's just certified to the seller. So I tell my buyers, I mean, you want your title insurance with this survey exception deleted. That's wonderful. It's one layer of protection. But if you have the survey company recertify the survey from the seller to you, you can go after them as well. So it's just an extra layer of protection for the buyer, and it's usually less than the full cost of a brand new survey.
Love it. That's perfect.
Lawyers are belts and suspenders kind of people. We want layers of protection for our customers, for our clients.
So the next thing that we skipped a couple of very nominal changes, but if you get to the seller maintenance obligation, now this paragraph talks about the fact that the seller has to maintain the property in essentially the same condition as it was when you went under contract, so the effective date. And so they added some additional language on here. The scope of seller's maintenance obligation shall not include or extend to any items which seller has no maintenance obligation, which is essentially association stuff. And the next sentence, whether existing prior to or after the effective date, seller's maintenance obligation shall include curing any and all violations documented by the associations against the property prior to closing date. So I think they're buttoning it up a little bit further to say the seller can't just let the house go into disrepair and get all these violations on it. I can't imagine we would close any deal with pending violations, but they added it in there just in case.
I hate to say it, I've seen too many sellers stop taking care of the property just because the property's under contract. That they might slack off on the pool service, they might slack off on the yard maintenance. The worst case, let the pets run wild through the rugged living room. I've had that. So the mindset changes with some people once they know they're not going to own it any longer.
Yeah, that's a great point.
In some cases, I mean,
well,
it's sad, but it happens.
It is sad, and that's where we want a strong listing agent. I don't really want the buyer to even have to ask. I would hope that the listing agent would step in and say, I know you're my client, but we have certain obligations, and let me remind you, we have to keep this property going. We can't let the pool go green. Those sorts of things, and what you've always talked about, Dad, is that it just pulls from the goodwill in the property, in the closing. It just eats away at whatever chance we had at a positive experience. And you tend to get less because of it, not more.
That goodwill, it benefits the seller because you never know what's going to come up, what favor the seller might need from the buyer. It benefits the buyer because they walk out of your office with a happy experience. They're more apt to use the realtor, they're more apt to use us, you're more apt to get more referrals. So anything you can do to avoid disharmony is benefits everybody. Yeah, plus it's a lot less stressful. It's an easier closing.
Gabriella has a good question from the prior part. If the seller cannot find their survey, should the seller order a new one? It doesn't require that be done. That's probably not necessary unless there's a reason that a new survey would put a lot of buyers at ease. If you just did a major renovation.
An easy way to deal with that, Christian. If usually they can contact their lender if they have one and get the closing statement, and the closing statement will show the fee for the survey. So you get the name of the survey company, and they can call that company and get a policy. I've done that quite a bit. I'll get the survey directly. Yeah. You just need to know who it is. If they remember who their closing company was.
Are surveys recorded? Can't you just get it online?
Some are and some aren't actually, and you can't get them online. You go to the courthouse and they have a special survey book, but some are recorded, some aren't.
Yeah, in fact, with my house, generally I would say they're not recorded, but they might be on file with the county or the city. So I live on Marco, and my wife was actually able to just call the city and say, hey, can you share anything you have? The city had elevation certificate, they had a survey, and they had the full blueprints when the house was built. Which was great, and we still use that today. So even if the seller doesn't have it, we might be able to do that.
Sometimes we know the survey company, and you have an encroachment problem, and I've had this, and we could just call the person who owns the company, and they'll go out and look for missing monuments. When they can't find the original monuments, they resurvey it, and they use the stakes. But we've had situations where the original surveyor went out and dug up under 5 inches of sand the original monuments and eliminated the survey setback issue.
Yeah, so the monument is the marker that they use to distinguish, a starting point or a property line, and so those are kind of like points of interest on a survey.
When they first platted
the Statue of Liberty at each corner.
That's right. That's right, Lady Liberty. So now getting into a part that looks quite changed, but I'll tell you isn't that changed, is the seller instruments and expenses. Now, this might be a section that most of you just skim or have maybe never even read. But in my business and in Kent's business, this is something that matters quite a bit because it drives why there are certain fees on the seller side or the buyer side. This is the basis for what your settlement statement looks like. And so let's just look at the seller side. We can look at the buyer another time, but seller shall provide and pay, when applicable, the following. So title evidence. So basically a title report maybe. 2, if the property is located in Lee or Charlotte County, the seller is going to pay for the title insurance. If it's in Collier County, that means the buyer pays for title insurance. 3, preparation of the warranty deed. Now, and that it also says the other things, bill of sale with warranties of ownership, things of that nature. It keeps going. Association estoppel letters, broker compensation verifications, tenant estoppel letters, copies of assignments of leases. So that is the basis for why sellers are charged to be represented as well. So some sellers choose separate attorneys than what the buyer is using, and others they piggyback off of what the buyer chose. But the seller's going to have costs because they have an obligation to prepare these documents and provide estoppel letters of that and things of that nature. For mortgage payoffs, document stamps is number 6. That's the transfer tax. Now, Kent, you and I have talked about this. Seller pays the transfer tax on the deed, and the buyer pays the transfer tax on the note. They are both transfer tax. Think of them as sales tax. And then the buyer also pays for intangible tax. And so Kent and I, we work very closely making sure that he's disclosing correctly to his buyers.
Be careful with new construction, by the way.
What was that?
To be careful with new construction, by the way.
Yeah, so actually that's
They
a great point,
around.
Kent.
That's a good one.
Kent says be careful with new construction contracts. And the reason he says that is because we had a deal a week ago where the builder just took all these costs and just put them on the buyer side. And I can guarantee you the buyer didn't know it. Or if they did, they may not have appreciated it the way that Kent does or that I might. But they took transfer tax on the deed is $7 per thousand. What was the purchase price on that house you were doing the loan for?
$680. So it ended up being like, it was like $5,000.
Yeah, so what I would do in that case is I take 680 times 7. That's about $5,000 on transfer tax. So the seller, in all his kindness and wisdom, said, well, buyer, you do it. And all it did, it's because they have their own contract.
Oh, by the way, they added a $1,500 builder fee on top of that.
Well, they add a builder fee, and then they cut your agent's commission. I heard some of the builders during COVID have reduced commissions down to 1% for a buyer's agent.
That's coming back now, but yes,
it's coming back to more normal. It's coming back.
Builders used to charge 1%, 1.5%, and then provide the title insurance and pay the doc stamps on the deed. So one way or another, they pass the fee along to the buyer.
They pass it along to the buyer, and you just want to make sure that you understand that. So whatever contract you're doing, go to this part of it and have your buyer understand, what am I responsible for? And then if you don't know something, call us, call my dad, call myself, and we'll explain what is normal or customary. And so that you can then go to your client and say, this is what's different from what was customary.
One thing that comes up a lot, Christian, it's regarding the title insurance. The seller pays for title insurance up in Lee County or Charlotte County, and they get to use an agent selected by the buyer. And that's a delicate thing just to let slide by the listing agent without the listing agent being fully aware. I mean, a lot of times it's somebody from Lee County who's not familiar with the NABOR contract. So you might be starting your transaction off by making the listing agent look foolish with their client. So you got to be careful.
Yeah. And then you get less from that deal later. You get a seller.
Yeah, you got to weigh it. And is it worth it? And do you want to come off as being too clever?
Yeah, I agree.
This
is something that we really don't want to see winners and losers. We want to see buyer and seller on the same page. And to the extent that we see a buyer and a loser, it usually ends in more cost for everybody and more gray hair.
Especially early in a deal like this.
You get dinged twice. You're selling in Lee and then you buy in Collier.
You could, but remember on the FAR bar contract, you can change this.
Right.
You dictate who pays. So I'll give you a quick example and we'll move on. I had a seller who agreed to pay for the title insurance. She was okay with, or actually it was the other way. She agreed to pay the assessment that was going to be due. There's a special assessment. The buyer asked, "Hey, will you pay this?" And she's like, "Look, it's okay, fine." It was like $10,000. So she was okay with it until she got her settlement statement at closing, and it had the assessment plus $10,000 in title insurance. And she felt like she was misled, that this isn't right, this isn't fair. And my friend, he says that his buyer paid title insurance and it shouldn't be. And it just, it blew the whole deal. It's still closed, but it put a very sour note on it, an otherwise clean deal that shouldn't have any problems. So it's kind of unfortunate. But I won't bore you with the rest of this stuff. It talks about FERPTA fees, it talks about wire fees, all those things. This is the beginning. This is the basis for why a seller pays for one thing and the buyer pays for the other. There's the condo here. This is our condo section, standard J, membership approval. So on this one, they added a little part that says buyer's right to terminate under standard J is conditioned upon buyer timely submitting the application to the association. Seller's right to terminate under the standard is conditioned upon there not being any violations of the applicable governing documents or outstanding balances. So what they're saying is you can't terminate under your denial from the condo or your non-approval from the condo or the homeowners association if you were late in applying. You know, you don't get both sides of it. You apply on time, and if you don't get approved, you can get out of the deal. But if you don't apply in time, you can't then use that as an excuse later. And I think that, and they kind of do the same thing for the seller. Say, seller, the buyer may be in default, but so are you. And that's what they put is that part there.
You have to have clean hands, basically. Clean
hands, as opposed to getting your hands dirty from before the sale.
Yeah, this time we want our hands to be clean.
This time. Awesome. Let's go over line 499, standard O, default and remedies. This is another part that, you know, this is the basis for all your negotiations. And it's a very quick read, so we'll do it. If buyer does not perform buyer's obligation, so if the buyer's in default, seller may terminate this contract, capital C. I love capital C's. What it means is it's a defined terms. Contract is this whole thing. So if you use a capital C contract, you don't have to say the one dated so-and-so between the parties. You just call it the contract. And so if the buyer is in default, the seller can terminate and receive all the deposits paid to the seller as liquidated damages. All deposits made. All deposits made. That part has not changed. If the buyer's put deposits down, that's the seller's liquidated damage. If the buyer has not put any deposits down, there really is no liquidated damages. If seller does not perform seller's obligation, so if the seller is in default, the buyer may enforce this contract by suit for specific performances, damages, or may terminate this contract. And interestingly, they don't say that you get your deposit back, but that's what would happen. So just as a reminder, buyer can sue and make you sell them the property. Seller can just take the deposits that have actually been made and then go cry. That's being left at the altar. I've told Kent that before. So some of the last parts here is notice, and we won't spend too much time on here, but they specifically said that text messages shall not constitute proper notice. So if you are texting back and forth and the seller agrees to repair the roof in a text message, follow up and get it in writing. Get your amendment or addendum signed, have it done. Do that before your due diligence period ends or your buyer election ends. Get it in writing. Text messages, they might swear, but not when you're in a NABOR contract. And
no, got a hold of my phone. I don't know what happened.
Yeah, I gotcha. All right, that's it on this one. The other thing I wanted to point to was they made all these changes in the as-is contract. They made these changes in the vacant land contract. So if if you understood those in the standard, you're going to get the same experience on these other ones that you may need to use later. The only other thing that we really saw here was that they added some language to the backup contract. And they say it right here at the top: in the event a seller desires to accept multiple backup contracts, the parties should seek legal counsel. All right, legal counsel. Dad, what do you think that means? Why can't you just accept multiple backup contracts?
You could be obligated to sell a property to more than one person if you don't put a contingency in the contract.
That's a big no-no. So if you were to reach out to my dad and I and say, we want to accept multiple backup contracts, but the contract tells me I need to talk to you first. Well, I'll be glad you did, because what I'll ask you to do is we'll put in, you are the primary backup contract, you are the secondary backup. We have to add language, because what we want it to do is everybody moves up one spot when the first person falls out. This addendum doesn't do that in regards to multiple contracts. If you did multiple backups without adding any language, everybody would move up at the same spot at the same time, and you'd be obligated to sell it to multiple parties potentially.
This is very tricky, so I really would call an attorney on it.
I've done this once in 5 years. It's not a huge thing, so don't overthink it. But if the market starts getting crazier, which it could this winter, we are seeing an increase. This may be a thing. And I like backup contracts. I like a seller having a go-to. I like a buyer having next in line automatically. I think it's very good for a buyer. But just don't get ahead of yourself. If you're going to do multiple backups, call one of us. We'd be happy to kind of walk you through it. That's kind of it. They did add a little piece to the post-closing occupancy, which you can see here. It's just access.
24 hours notice.
I think it's really straightforward. So that was a lot. You know what? It was a lot, but in 48 minutes, I think we covered all the changes.
There you go.
This is a great opportunity. Dad, you and I talked about this. You said this is a great opportunity for people to reread the contract.
Review it. There's a lot of material there.
I think most of the things we would even point you to are things that didn't change. Reread the seller maintenance agreement or section, reread the inspection language in the standard contract. Make sure you understand the timing on buyer election and seller response. Financing contingencies. This is a great time to brush up on that. We are going to see people getting mortgages. Kent, thank you for being a party to this. And I think I would personally recommend my clients reach out to Kent. I think you've got the right connections, you've got the right products. What's your favorite product right now that Fidelity is offering?
Free money.
Yeah, free money. Probably that 2-1 buy down, just because rates being where they are. It's a seller paid buy down, so your customer as a buyer doesn't pay it. We knock your interest rate down 2% from where the current rates are, and you get a temporary rate decrease while we're waiting for rates to decrease. So
yeah, it's a great hedge. In fact, Kent, I read there was an economist that said economists generally like variable interest rates because rates are going to go up when inflation goes up, like we're having right now. And with inflation, hopefully your income, everything would go up collectively. But then as inflation were to decrease, your interest rates are going to come down with it. And now you have more of a windfall. It's not a perfect thing for those that are more month to month. But when you have more discretionary income, the variable interest rate actually benefits the home buyer more than you would think. It was a very interesting thing. You give up.
It can. The problem that we're having right now is we have what's called an inverted yield curve. So for instance, what that means is a short-term bond, so a 2-year bond right now is paying a higher yield than a 30-year bond. So it's backwards, meaning if you want to go look at a 5-year ARM, the rate isn't better than a 30-year fixed because they're inverted. So until that gets back to normal, variable rates aren't going to really be doing much until that happens. So
interesting. Well, I appreciate it. Thank you everyone for joining. We had a good group. Again, if you want to look at any of these videos on demand later, go on to YouTube, and it's just youtube.com/Christian Ross. And reach out to any of us. Kent, thank you. Dad, thank you.
You're welcome.
Bye, guys.